Okay, we're live streaming. Very good. Go ahead and add my recording on the local. Okay, guys, here we go. So I'm gonna go through my slides and then I'll do Q&A at the end. But use your chat box, find your chat box. I don't open the mic, I do chat questions. And there's a ton of people in who are checking us out for the first time. Welcome. Emergency webinar, bank implosion underway. Buy these 5 stocks for instant profits. Our high risk year-to-date total return is now up 20.34%. This is outperforming the S&P 500's 5.46% return by 4,835%. The Federal Reserve is days from pausing rate hikes. It could be this Wednesday, if not the next meeting. With Credit Suisse blowing up today, probably rate hikes are done officially. They have no choice as banks globally are now blowing up left and right. It's because they bought a ton of bonds on guidance that inflation was transitory. And then the Fed jacked interest rates up at the fastest pace in history and blew up all of their balance sheets. First, it was Silicon Valley Bank, then Silvergate Bank, and then Signature Bank. Now Credit Suisse, a systematically important European bank, is on the verge of collapse. Switzerland most likely will have to bail out this bank as well. If they don't act, pension funds globally will start cracking and the political chaos will be out of control. The money tightening must be reversed to stop the pain, despite inflation still rising in Europe and still sticky in the USA. Now we have 2 products. Our safe growth portfolio, which is massively long bonds, is up 7.35% in March. Our high risk portfolio, which is taking riskier trades, is up 3.41% in March. The gains are about to pile in as the central banks bail the system out in the weeks ahead. High risk portfolio allocation. All our members follow a unit of investment. This means when you log into the membership area, you type in how much money you want to invest, hit calculate, and it's going to divide it out so that everyone has the exact same ratio of shares. This means we all get the same returns every single day. In the high risk portfolio, we currently have a unit of investment costing $1,876. Each building block or unit consists of 20 shares of UVXY, the crash insurance hedge. UVXY, after being a dud for a year and a half, is finally getting that asymmetrical return. We've been seeing lately with the SPY down 1 to 2%, it jumping up 10 to 20%. So we're finally getting the VIX to behave rationally. So very interesting. We may add to that soon. Next, we have TMF, 49 shares. This is the long end of the US Treasury curve, leveraged times 3. So what we're hoping is that interest rates fall in a deflationary fashion. And that's my highest conviction trade over the next 2 years, and why our safe growth product has half the portfolio in this position, while our high risk has a quarter. So that's on the deflationary defensive portion of the portfolio. On the offense, we're loaded up on Coinbase, ticker COIN, 9 shares, which is doing very well this year. It's the last white knight standing in its space. And as far as the stock market goes, I believe it has the best exposure to digital currencies, which has a massive, massive return ahead of it over the coming decade. Next, we love the beat up tech names. So FNGU gives you companies like Apple, Microsoft, Tesla, Facebook, NVIDIA, a whole bunch of them. Leverage times 3. This has been doing very well. Also, 8 shares. And then finally, our energy hedge has been a complete piece of crap this year. We've let it just dwindle down and have not changed it. I'm looking to switch over to NRGU for the top 10 US oil and gas companies, leverage times 3, and adding in FAS, which is the big banks. What they're doing is essentially making all the small banks collapse and consolidate all the cash towards the top. So FAS gives you those big banks, leverage times 3. Now, with those puppies down about 10% each today, I held off on the trade alert. Essentially, what I see coming down the pipeline in the coming weeks for a future trade alert will be to pull a little profit off of the bonds, the tech, which is Coin and FNGU, and to get a little bit heavier in the banks and the oil and gas companies. And that'll make our portfolio quite similar to Warren Buffett's general strategy in terms of having a large cash position. We have the treasuries, a large tech position with Apple. We have Coin and FNGU, and then he owns a lot of Occidental, which is in NRGU, and then he owns several big, massive banks, which we will get with FAS. So we're waiting on that trade alert. Those two tickers getting crushed today, but that's what I see coming down the pipeline soon. Here's our return for the high risk strategy. We pulled a 233% return in 2021. 2022, we were up as much as 50%, gave a lot back in the winter, closed out down 12%. 2023, we're kicking some butt, up 20% year to date. Safe growth portfolio allocation. So a lot of our clients, depending on their risk tolerance and their timeline, their horizon for retirement, will put some money in the safe growth strategy and some in the high risk strategy. That's up to you to decide, but this is the allocation for our safe growth portfolio currently. Again, when you have a login to the membership area, just punch in how much money you want to invest into each strategy and it'll print out exactly how many shares to buy. Per unit of investment, we have a $1,075 unit per building block. We've got 8 shares of UVXY, the stock crash insurance play. We're massively long treasuries with 57 shares of TMF. We have the S&P 500 times 3 with 2 shares of UPRO. We have emerging markets, which is the ticker EEM, leverage times 3 by buying EDC. So again, we're playing the ETF EEM, leverage times 3 with EDC, 6 shares. That's a bet on essentially interest rates falling, the dollar falling, and outperformance out of Asia, led by China. And I do like that play a lot. We've got 11 shares of the Grayscale Trust, GBTC. Next, we have the Triple Q, that's the NASDAQ times 3. So it's like FNGU, but it's the entire NASDAQ instead of just a hand-selected group of the biggest ones. And then we've got that tiny energy hedge with BOIL. What I see coming down the pipeline for this portfolio is to dump UPRO, BOIL, trim down TMF, and then add in essentially FAS and NRGU. So I'm wanting to get both of those products back into here. And it looks like mine is recording, Ryan. So, okay, very good. This product had a 25% return in 2019, a 4% return in 2020. I was a little bit, I missed some of the gains at the end of the year on that one. 2021, we returned 25%. 2022 was tough. We lost 25%. This year, we're currently up 4.28%. Now, if you want to learn more about our products and services, give Dean Gallagher a call. He can walk you through it. He can help you fill out the trade alert at 505-322-7515. This is a quote from Buffett. The best time to buy stocks actually was in recent years, has been when interest rates were sky high and it looked like a very safe thing to do to put your money into treasury bills. Actually, the primary got up to 21.5%, but you could put out of money huge rates in the early 80s. And as attractive as that appeared, it was exactly the wrong thing to be doing. It was better to be buying equities at that time because when interest rates changed, their values changed even more. So the stock market is typically valued against bond market interest rates. If interest rates fall, the relative value of stocks goes up. That's exactly what we're predicting is interest rates are going to fall. New data in today on the PPI. Falling. We had retail sales and PPI falling. This has been leading the inflation front. So it began rising before inflation was rising. It began falling before inflation was falling. We're quite confident we have a good year ahead of inflation falling. Now, if the governments start reversing monetary policy aggressively, That's definitely going to put a headwind in the inflationary picture. Here's the latest CPI that came in a little bit stickier than people hoped. We can see in red energy, which led the inflation originally. It also led the deflation when we locked down the country. So it's the most volatile. Remember when we locked down the country and oil prices went negative? That's what you see in the negative area in the red in 2020. Once we got the economy back online, it skyrocketed up. And now today we have energy warning us of deflation and slowing economic developments, with oil down as much as 7% today. So we believe the sticky inflation, which is in core services and food, we're going to see this start to fall. In fact, the BLS, which measures the inflation, has shelter and rent hitting all-time highs in the latest CPI data at 7%. But the reality is it's been falling for almost a year now, and they're looking at data that's over a year old. So we're going to see 35% of the CPI components soon flip to deflationary, and this is going to be a huge headwind towards dropping inflation rates. This is an interesting chart comparing the money supply to CPI over the last 2 decades. This is predicting essentially that we're going to see inflation fall for about another year and a half, unless they jack up the M2 supply, which is exactly what we're starting to see with the recent bailout of the banks in the US. And we're probably about to see the same thing in Europe. This is the 70s, where we had similar inflationary issues. Different labor force participation rate. We actually had it rising that whole decade. We don't have that today. But either way, you can see M2 is highly correlated to CPI. And once they crash the M2, the CPI shortly follows after. Federal funds peaks have in the past signaled big gold rallies. We're seeing a good correlation between gold and BTC once again. But we just have a longer track record of how gold has performed throughout history compared to BTC, which was only invented in 2008. The point here is that when the rate cuts, when you come from high interest rates, you pause and then you crash the economy and flatline. While you do get some volatility, it ends up with these massive bull markets in gold that can span for a decade. And looks like we have a great setup for both digital currencies and gold coming in as we have high levels of inflation, but the interest rate strategy has broken the banking system. And the root cause of all this evil is, of course, too much debt being spent on an annual basis by governments. So unless they want to balance their budgets, our plan is pretty rock solid. This in a nutshell shows you what's gone wrong. The Fed came out for the last 2 years and told us all that inflation was transitory and there's not a chance in hell they're going to hike interest rates, and that they're not even thinking about it. And then all of a sudden the inflation kept roaring higher as they kept doing QE, and they had to slam the brakes on. The process of slamming the brakes on has suddenly caused banks to nearly have $1 trillion in unrealized losses. So what we got going on now in the US is a new facility. It's the same as all the others, just with a few tweaks, basically allowing banks to hand over their bonds, which could be down 50%, to the Fed, and getting 100% of their original value in a dollar loan. So if I bought a $100 bond, it was only worth 50 cents today. I can now go to the bank and get $100 back in cash and let the bond go to maturity, so I don't ever have to have a liquidity issue. So that's a massive quantitative easing program essentially for banks. It's going to make banks want to load up on bonds and leverage out their portfolios because they know there's now zero risk. So this is a huge development. We're probably going to get a similar setup in Europe. We're probably going to have global banks have to stop hiking interest rates, because the more they hike the interest rates, the more negative all these portfolios go. Here's Silicon Valley, the second largest bank failure in history, $209 billion in assets. And the 2-year is telling us rate hikes are done. They're crashing way below the expected federal funds rate. This is the biggest crash in the 2-year ever. The only time we've had similar 2-year crashes, it was usually in advance of major market collapses. Now, the problem today is that our debt levels are extremely higher than ever before in history. You'd have to go back to World War II to find debt to GDP levels of this magnitude. So they have to be much more proactive about stopping financial crises before they begin. So they very well likely will fix the problem potentially before a big crash. Here's the channel for the long bond, and this went way, way, way above the trend line. I believe we will see this bottom out below 0.99, probably close to zero, and probably somewhere between 2025 and 2027. We're going to have some gyrations on the way there, but that's really the big, essentially 5 to 10 year cycle to hit the lowest interest rates we're going to find this cycle, and to pull massive profits off of assets that go up when interest rates fall, which is primarily essentially digital currencies and tech stocks, which is what we're loaded up on currently. This is looking at the yield curve inversion relative to recessions. When the yield curve steepens, you get the recession. But leading into that, you get falling interest rates. The first half of the interest rates falling, typically very bullish for the market. But if the economy slows down too much, you enter a stock crash and those yields go even lower. So this setup we have coming up right now is typically very good for markets. Now, I'm not worried about a recession currently. We have really tight labor markets. We continue to pile on jobs. In the last 2 months, we added 800,000 paychecks, and there's over $1 trillion in savings. So we started after the lockdowns with about 2.3 trillion in excess savings, and they're still sitting on 1.3 trillion in savings. So there's still a ton of money in bank accounts, not even in money market accounts. The amount of money sitting in money market accounts, T-bills and such, is even more massive. So as soon as the expectation for interest rates to go down, we're going to see a major melt up here. The data, well, it's been sticky on the hard data in black, and in the inflation in red, even stickier. The soft data and leading data has gone highly negative, which indicates that the CPI is going to fall dramatically in the coming 12 months. Here's what we're talking about with the inflation. They just printed the highest level of shelter inflation in history, going back to 1990. But the reality is the real-time data is showing that from US rents apartment listings, it's been crashing since November of 2021. So we're very close to the shelter CPI from the BLS turning over and falling rapidly. It's bizarre why they use 12-year data, 12-year-old data for current CPI. This is looking at tech versus energy, and essentially predicting we're about to have a big boom in tech and a crash in energy. Now, again, those two go very well hand in hand to hedge one another. So we're being a little more patient to build out the energy hedge. I do think as soon as the Fed does pause and stops all this tightening, that we are going to see a resurgence of inflation, especially in energy. But in the short term, the drop in oil prices is causing Russia to ramp up production to keep their economy alive, to fuel the war. And this increase in production is actually driving the price of oil even lower. So I think a little patience here is going to really pay off to add in NRGU, as well as FAS, the banks, to our portfolio. Stock market returns during rising inflation, 5.5%. During falling inflation, 14.7%. Rising rates, falling rates, about the same. Point here is when inflation's falling, you have on average the best returns in stocks. This is looking at PPI, CPI, and M2, and they're all clearly pointed to the downside. Now, again, once we do get central banks printing money aggressively, M2 is going to bottom and start rising. And I don't think we're going to see the PPI and CPI go below the trend of the M2 if it's starting to move up quickly, because the market's going to start front running that. Okay, so here's the performance of the S&P 500 once the Fed hit pause. Not rate cuts. Remember, they cut rates in a crash. They pause when things look good. And the returns from a pause to the peak are 104% in 84 to 87, 39% in 88 to 90, 166% from 94 to 98, 11% And the dot-com, that turned out to be a head fake. It wasn't the end of the dot-com crash, obviously. 06 to 07, 28%. Again, that did end up with a crash, but not for another year and a half. And then 2018 to 20, 44%. Okay, I was telling you, money market has even more money than bank accounts. Money market funds sitting on $5 trillion that can pile into assets as soon as this inflation is coming to a close. This is looking at liquidity cycles. You can tell we're at very extreme tightening in money supply globally, and we're quite likely going into an easing period very, very soon. This is looking at the US government's debt. A ton of it is entitlements. There's zero chance. This is predicting a $1.38 trillion deficit. Recent estimates are higher at about 1.6. If interest rates stay at this level, we're going to be spending more on debt payments to the US's lenders than we do on the military budget. So it's completely unsustainable. The numbers don't add up. They have to get interest rates down if they want to keep growing the spending. And unfortunately, the voter base will not vote against it. Another thing lining up is, and this is starting to get blown out right now, is there's a record historical short position in Treasury futures. These guys are getting short squeezed. So get ready for interest rates to fall rapidly, especially if next Wednesday, Powell says we have to pause rate hikes. Okay, so we're going to go through some charts of each position now, and then I'll go into Q&A. Step one, this is just covering the high risk portfolio. A lot of the charts are really covering both products. So buy 9 shares of Coin, your ultimate growth product for digital currencies. It's been a rickety month, but flat on the month. It's down 65% in the last year. Buy the dip. The fundamentals of this company get better by the minute. Only negative side is the politicians, especially in the Democratic Party, are clearly targeting these companies. They took out the 3 biggest banks related to it. The New York Attorney General is trying to sue KuCoin, claiming one of its coins is a security, and it's called Choke Point 2.0. I do think we will survive this clearly, and it's still one of the best performing assets year to date. Our favorite of the digital currencies is ETH, and it's up 6.3% in the past month, 121,000 return all time. And the Grayscale Trust version of this is ETHE. We're not currently in that product. There is a hearing trying to convert this from a trust to a ETF, and so far it's looking pretty good. I'll keep that updated. And again, if we want to be long digital currencies or tech stocks for that matter, we basically want to bet that the bond market's going to grow and the interest rates must fall over time. And if they're planning to grow the deficit, this is the CBO's own estimates, and obviously they're way lower. 2023 is already at 1.6 trillion deficit, with the estimate previously being at 1. They're planning to grow it to 2.3 by 2032. It'll probably be closer to 3. I think these are all probably off by 30 to 50% lower. But these are the deficits U.S. government has to spend to keep everybody happy. So it's going to dilute the value of the currency, obviously, and drive certain asset classes sky high. Okay, again, questions about this, call Dean. We have an alternative to ETHE and to Coin where I manage it for you with leverage. To learn more about that, call Dean at 505-322-7515. It also comes with a weekly dividend. So we could finally be getting out of the bear market for this asset class and entering the new bull market. The more the banks fail, the more money they print, the better for us. Okay, this has been our worst trade this year, BOIL. It's just the factors that combined was Europe did a very good job of cutting off its use of natural gas. They spent a ton of money filling up their reserves. They got a warm summer. All of this combined has led to the crash in natural gas prices. We're probably going to switch over to NRGU, but we're being patient. Here's NRGU tanking today. This puppy can certainly go way higher. We played it last year and made a lot of money. We played BOIL last year, made a lot of money. And I think the time again will be coming. Perhaps we need to wait another month or two. So we'll be patient. And we caught a good day to to wait because we have oil crashing pretty hard this morning. Crash insurance, UVXY. This has been a real dud for the last year and a half. I'm not quite sure exactly how they were keeping it muted. I believe big market makers were essentially stunting the VIX and using this to stoke the market or to slow down the stock market crash of last year. It seems like that strategy for stunting it is gone because now we're seeing huge gains in UVXY in the last few days when the S&P 500 was only down a little bit. So this product's looking a lot more attractive. I might add to that sooner than later. We'll pay attention to that. This is UVXY during the lockdown. And I want you to note it went up over 1,000% in a month when the S&P 500 went down 25% in a month. That rarely happens in history. It takes something completely unexpected and for lots of things to break at once. But it just goes to show how powerful that product is. If you had 10% in UVXY in the lockdown, that 10% doubled your entire net worth. So your other 90% of your portfolio could have gone to zero and you wouldn't even have had a scratch. This is comparing the VIX today to the 2008 analog. I think the only thing that would really cause this would be if regulators don't bail out the banks, which I believe they will, or the inflation came ripping in way harder than everybody thought, making the Fed hike interest rates even higher, which I also highly doubt. So I don't think we're going to get that big market crash right now. Bonds, TMF. Okay, so TMF is up 11% in the last month, down 54% in the last year. It's a leverage play on the TLT, which is up 4% in the last month, down 20% in the last year. We look at other bond markets. This is feeding the investment grade corporate bonds, LQD. We're not in this, but keeping a look at its health. Flat in the last month, down 11% in the last year. The junk bond market's feeling a little more pain in the last month, down 2%, down also 11% in the last year. Okay, now we're looking at short-term bond products. This is what's pretty much affecting the federal funds rate. And the recent moves are that the Fed has to pause. So the 3-month has crashed from a high of 5 to 4.76. Here's the look at it. So it was going straight up and now it's falling. The 2-year has just plummeted from 5 down to 3.8. This is way below where the federal funds rate is currently at and indicating that they're probably not going to hike next week. So this is one of the biggest collapses on the 2-year. This typically is warned of big problems in the economy and given a lot of warnings. So we're on high alert for more problems. But if the central bank's policy decision is to loosen money, that probably will delay the problems of financial instability. The catch is it's going to reignite the inflation. Okay, 10-year also falling, as you can see. Okay, lumber futures haven't been doing anything but crashing for the last year. Copper futures, everybody's expecting this to go sky high with China reopening. Not happening. We have had a bid since August, but it's nowhere near the highs we had just a year ago. Baltic Dry Index is down 50% from the high in June. And you can see it's back to normal levels. This is cost of shipping commodities between continents. Wheat futures, while getting a little bit of a bid, are down over the last month and down over the last year. So we're really seeing the most volatile parts of the inflation predicting deflation. We're not in the dollar right now, but again, in general, we're expecting the dollar to fall to 90 this market cycle. And that's when we're going to want to take profits on digital currencies. And this will be followed with falling interest rates. Here's the Japanese currency, which was devaluing and starting to gain some strength. And the Chinese yuan trading about sideways after devaluing for the past year. Okay, stocks were in FNGU with 8 shares. FNGU is down 14% in the last month, down 64% in the last year. S&P 500 is down 6% in the past month, 13% in the past year. The Nasdaq's down 3.5% in the past month and 15% in the past year. This chart's showing you that every other market cycle, typically emerging markets outperforms. Emerging markets does really well when US interest rates and the dollar index are valued extremely high and fall, which is exactly what we're expecting. So EDC could be one of the best indexes for the coming 2 to 5 years. European markets, EFA, down 3% in the last month. It's funny that all this problems are happening in Europe and their stock market's been doing quite well. We're not in uranium, but come summertime, perhaps when we add NRGU, this could be an interesting play. URA down 17% in the last month, down 27% the past year. Rare earth metals, critical for batteries, down 16% in the past month and 31% the past year. We're not in this, but it's something on our radar as well. Let's look at some of the big tech stocks that are inside of FNGU. We have Amazon down 5%, down 41% the past year. If interest rates are about to fall and we're not entering a recession, this could be a hell of a buy. You get it leverage times 3 with FNGU. Apple down 1.7 in the past month and down 7% in the past year, holding on very strong. Alibaba, which you get with EDC, down 21% in the past month and down 25% in the past year. Baidu, also part of EDC, down 13% in the past month and down 12% in the past year. Facebook keeps doing layoffs and the market loves it, probably because what they saw happening with Twitter operating fine after decapitating 90% of its staff, up 11% in the past month, only down 9% in the past year, making quite the comeback. Google down 1.7 in the past month, but down 30% in the past year. We love picking up these tech stocks at a big discount when we believe interest rates are going to fall rapidly without a recession. Microsoft down 1.5 and 12 in the past year, also part of that FNGU. Same thing with Netflix. Again, you're getting most of these tech giants at a pretty good discount. Tesla down 40% in the past year. Okay, let's take a look at the banks. This is going to be a new trade alert. We're going to be a little more patient. It looks like this contagion in the banking sector is spreading. And even though they've done a little bit to help out, let's just be a little more patient. So FAS for the big banks, NRGU for the big oil and gas companies. Those are the two new plays I want to get us into. I'm not exactly sure when I'll pull the trigger. We got to watch this all develop closely. Bank of America, JP Morgan down a lot. Now remember, the problems are not in the big banks. It's in all these smaller banks. And what's happening is going to flood money to the big banks. So they're going to get stronger. And we do want to get those back in our portfolio. Okay, very good. Again, if you want to join our program or learn more about our private equity to replace coin, call Dean at 505-322-7515. Okay, I'm going to go ahead and do Q&A. Very good. Huge crowd today. Thank you everyone for joining. I'll go back to the very beginning now and review the portfolios one more time, and then we'll see you back next Wednesday. So we did switch to updating once a week on Wednesday because I'm not a super frantic day trader. Very patient, slow moving. I do a couple trades when it makes sense, when the big macro picture is actually changing. So let's review again. In the high risk portfolio, what we're looking to do is add FAS, FAS, and NRGU. And to do that, we're going to dump BOIL. We're going to shed a little bit off of TMF. We're going to shed a little bit off of coin. We're going to shed a little off of FNGU. And then we're going to add in the banks and the energy companies. But be patient and maybe top up UVXY on a big update. Okay. On the safe growth, we're going to swap out UPRO BOIL for FAS and NRGU, and we're going to trim down our treasuries, and we're again completely exit UPRO and BOIL. So those are the two trade alerts. Timeline, we need to watch this all develop. If the Fed is super dovish next Wednesday at the close, perhaps that would be a good time to do a reallocation of capital. If they're going to let things blow up a while, we need to be patient, let them blow up stuff. So that's pretty much what we need to watch out for. Free trial guest says you haven't mentioned Ukraine. Any outlook for the end game and positive developments here? If so, what would be the portfolio implication? If the war ends, I would say that we're going to see demand pick up and interest rates fall and supply chains fix themselves up quite a bit. Aaron says, what's the difference between BOIL and NRGU? So BOIL is playing futures contracts on the price of natural gas. NRGU is owning Exxon, Chevron, Occidental. So one, you're looking at a oil company trying to deliver profits, and the higher the oil price is, the more profitable they are typically. BOIL, you're actually betting on the spot price in futures contracts, and there's different months, so it's playing a couple of months against each other. So totally different game. I think BOIL will be a good play if Ukraine war is still in the books this winter. So if the war is still marching on and BOIL's still super low coming into winter, I might add BOIL back. Now, if there's nuclear bombs going off, that's obviously good for UVXY and treasuries in the war, but I don't anticipate that. So yeah, that's where we're looking at the markets. Again, we are doing a weekly update now with the live webinars. So next one will be Wednesday. If you're in Rebel Dividends, our next webinar is Tuesday. So I'd like to thank everybody, and we'll see you back next week. You can always reply to any email that comes out, and it goes to me if you have any questions. So thank you so much.